This week, markets sold off badly. The S&P 500 is down, NASDAQ down, Dow Jones down, gold down, silver down, Bitcoin down. Seems like everything is down. But there is a sector that is holding its ground, which is not great for us. We don't want this sector to go up. It just makes things more and more expensive, which increases inflation. And increasing interest rates is not going to solve the problem. But that seems like what the Fed and other countries around the world are going to do. It's not the thing that is going to solve the problem, but governments and the Fed have run out of options this late in the 18-year US real estate cycle. Everything is going to plan according to the roadmap of the cycle, but unfortunately, it's not where we would like things to go. It's just how the cycle continues to unfold. Now, if you're prepared for the cycle, maybe you're in a better position. If not, then this is the video for you to watch. So make sure you subscribe to the channel to follow the journey day by day as we see the markets continue to unfold as per the 18-year cycle. And if you find value, obviously hit that like button. So we're going to start with the fear that's come through on the markets yet again. S&P 500 and commodities first up. So CNN Business down to 15 on the extreme fear. We are watching for a short-term local low on the S&P 500, but I'll talk about that in just a moment. What we have seen over this week, of course, is Trump talking about ceasefires, but then dismissing ceasefires, saying that he's finished up in Iran, winding down military operations coming straight from the president. However, there still seems to be more personnel going over to Iran to help with the situation over there. We'll know more next week, of course, as we all often do, but this comes late in the working week and basically around the time when markets were getting ready to close. You can see it was at 7 p.m. Time, basically a couple of hours after the markets had already closed. So they may be pricing this in when they reopen on Sunday evening Eastern US time, and of course Monday morning for us in Oz. Now, in terms of the big events that have happened this week, at least from the economy's point of view, the interest rates in the US remained on hold. And as if you've been following the channel for a while, you know we've been talking about interest rates remaining on hold, if not going up. And when we check the probabilities, well, from last video, it's only been 3 days. And what have they done? 2026, there is way less chance of any interest rate cuts. So this is exactly what we've been talking about over the last couple of years. Reason being is that it would be unwise to cut interest rates while there was that much inflation going on. Seems like the Fed came to the party too little too late. Two major reasons for the interest rates remaining elevated. One, unemployment. Two, inflation. Now, we have seen unemployment tick down slightly. This was on the December reading, but it hasn't broken any of the prior lows, and it seems like it's just a short-term downtick on the unemployment before it eventually ticks higher again. You would think that with higher unemployment, we need the interest rates to drop so that they can start to fill those positions again, make life a little bit easier for everyone. However, we know they're in a very, very difficult position now with one, inflation sticking around and looking like it's getting higher because we are seeing agricultural commodities increasing. That is things like sugar, wheat, soybeans, corn. These are all used in other areas of food industry as well, obviously to feed cattle and livestock and things like that, plus using clothing. So basically everything we need to feed ourselves and to have clothing are going up. Along with that, we know oil is also going up. So then to transport all of these commodities is also getting more expensive. Now, like I said in the intro, this is something government can't control. You can't control whether there's going to be a natural disaster, like something that wipes out half of these crops. You can't control if another part of the world is looking like they need more of a particular crop. Say China needs more or Brazil needs more soybeans to feed their cattle because maybe they have a natural disaster where they're going on. These are just speculative insights for that market, but we are seeing those prices increase and we're seeing bases come into some of these agricultural commodities. So unemployment continues to remain elevated. It's at historically low levels, but coming off a base in 2022, 2023, we haven't seen that level for 2 to 3 years now. So it seems unlikely that unemployment's going to reverse and come back to those low levels underneath 3.5%. And when unemployment does start to rise, it's inevitably met with a recession. We don't know exactly when, but we know one is coming. We're not trying to call the end of the world, never have been a doomsday channel here. We're not ever just looking out for a bearish scenario. What we're watching for are signs of the peak of the real estate cycle and then eventual downturn. Now, another sign that the market is signaling to us is or are the government bonds. The yields have skyrocketed over these last few weeks and broken some key levels. We haven't got back to around the 4.5% or so, which would be halfway through this decline. But this has been a relatively strong move over the last 3 weeks, coming off a very low base. If not, it was like a fresh 4-year, 3.5-year low. Now trading at 3.9% on the 2-year yields. The 10 years have also risen, taking out some recent highs, trading at nearly 12-month highs. The 30 years getting close to the 5%, but also fresh highs of the last 6 months. So why is this important? Well, while the yields have been increasing, we've seen the bonds decrease, which means governments, major, large industries are not as keen on buying US government bonds, which means those prices are decreasing, which means the yields have to increase to make the investment look attractive again. And so if the market is signaling higher interest rates, 30 years up, nearly call it 5%, 10 years, 4.4%, the 2 years are nearly at 4%, it seems unlikely that the Fed is going to be able to drop the interest rates, even though unemployment is rising. We've seen unemployment remain elevated off the lows of 2022, 2023. So unemployment is rising, which means the people would need to have some interest rate cuts to make things cheaper. And then on top of that, we're also seeing an increase in agricultural commodities. We can see wheat. It started to jump here. Pretty big rise. If you guys aren't following this, definitely get onto your agriculturals. Look at that over the last few weeks, couple of months, up nearly 20, 25%. These are sort of things that we go into detail with members. TIA Pro, there's a link in the top of the video description, and how to profit and navigate your portfolios through the 18-year cycle. I'll talk more on that later and in future videos as well, but that's what we're seeing across the board with agriculturals. And there is the chance of those breaking out. As I said earlier, you've got soybeans, corn, sugar has also had another big push higher. And some of the others which have had a run like orange juice, cocoa, coffee, cattle, which is your meat, they've had pretty big runs and they look like they're also due for some bounces as well. So this, I think, from what we can see, is only going to get tougher for the government and put them into a bit of a position where they don't really have an opportunity here to cut the interest rates drastically enough to make it worthwhile or to actually help the people because of what else is going on, as we've just discussed. So does that mean come Monday morning, everything collapses, the cycle's over? I don't think that's the case. This is what I've been sharing with you for the last few months. It's our 2026 roadmap. The purple line is the midterm years, and the yellow orange line is the 60-year cycle. Now, we're due for a bounce, but in many of these cases, the bounce comes up to a lower high for the stock markets. So you can see from the bounce, these vertical lines are the months, the horizontals are just some percentages. So we're not concerned with that. We're just concerned on the shape of the market. So a bounce is due, but eventually it heads lower. So we're looking at this as a bounce here into roughly April, and then for it to head lower. Another reason for that is that we've now exceeded or hit the target of the overbalance in time and price. That just means that we've had an uptick in selling pressure in terms of price and in terms of time. So the pressure has gone on for longer than any other time in the rally since the April low. So that's coming up to about 12 months now. There is your April low. That was tariff collapses from 2025. The largest correction we saw in this run was October through to November. So barely 4 weeks. This time, we've seen it double that in time, so it's gone on longer from that point, and the prices have exceeded that, which means more selling pressure has come in than any of that move. So how does that affect our fractal that we've been following for nearly a year now of 2020 to 2021? That's what this red line is in that you can see here on the chart. Well, around this point, about 3 to 4 weeks ago, we started to see some divergence where the fractal was heading higher for the next few days, whereas the actual price was heading lower. Now we started to line back up with that, and we saw the tops come in a little earlier this time. So the two things here: one, there is more weakness in the chart now than there was roughly 5 years ago. Two, the roadmap and the cycle is following a more bearish pattern that we can see in the orange line here, which lines up with our 60-year cycle. So in both of these instances, whether it's the 5-year fractal, whether it's the 60-year fractal, whether it's our 20 and 60-year fractal that we've also talked about, there still seems to be a bounce coming. But the key difference here is, and what most people tend to not hear, is that this bounce now looks more likely to be a lower high than it is to be a break of the high and continued strength in this window of about 3 to 6 months. Now, of course, it's possible, but you've got to take a side. You take whatever side you want. At the end of the day, it's your money and you can do whatever you want. I'm just reading out the charts to you and hopefully being able to interpret the language of the charts and share that with you. But yeah, looking at any sort of rally from this point, I think it's going to be a little weaker. Now, it can touch the top, go a little higher, but that's still a weak signal overall. That's what I don't want people to forget here. Even if it does rally, just past those highs, but if it closes underneath, that's still a weak signal because it turns into a double top, which just sweeps the highs, falls back underneath, which is a weak signal again, and then you'd probably see the market continue to fall from that point. But it would still be following a similar pattern to this. That's just the shape. You can see the shape is up. Is it a strong up where it breaks the highs and holds on top? Or is it a weak up, which comes to a price around like we just said, and then begins to retreat again? That's the big question coming into April. And I've given you my thoughts on that. At the end of the day, you take the position that you want to take. So that's a look at the S&P 500 backed up with everything that we can see going on in the markets, along with the commodities and so on. Now, what else is happening with gold and silver? Well, we've seen some massive days and weeks down here for gold and silver. Gold was off about 10% on the week, now down 17% from the lower high. I don't want to say it, I hate to say it, but it's basically what's happened before many, many times. Talked about it in videos. Obviously, it gets shut down by people who are very much in the gold and silver camp, and they only think that it can only ever go up. But you've seen me share this leading into the peak, and here we are, having hit the peak in January in Q1, which is exactly what the last 55 years of history have said. Generally, you see a top in Q1, if not a little further in April, and then there is a significant correction. Now, what we're looking for is this going to be a consolidation after the correction here, consolidates and then a move higher, or is it over? And is it over for gold and silver? You can see the large moves up that we saw in 2011, and then the market collapsed from that point. And of course, the same thing in 1980, big moves higher and then the collapse. That's the big question next. But I've talked about the key signal to look for. Well, what we're watching now are higher lows and then higher highs. And the market now has given us those points. We've got the highs. And if we start to break those highs of $96 for silver, we could be on, right? We'll just look at this whole area as consolidation before another move higher. If not, then we head lower. Same thing for gold. Gold is coming back to the next 50% level around 43.75, 4,400. If it's able to hold, we've got some levels a little further down, but if it's able to hold in this zone, consolidate, and then move higher, we're all looking good. So at the moment, pretty severe moves down on the metals as well, whereas for oil, it's holding up here. Even though it was a red week, it was only a marginal and still closing around those levels. So a pullback seems very healthy at this point, consolidation, and see if it can continue to hold the levels before it heads higher, which is not a great thing for, I guess, all of us, because of course we need to live. We need to use oil basically for everything. That's transportation. Even if you don't agree with using oil and you only want to use electric cars and whatnot, you still need oil to move all of the equipment around in order to produce that electric equipment. So that's the problem, the dilemma that the governments now face with the oil prices remaining elevated. And then these agricultural commodities also looking like they are beginning to push a little higher. As for the gold and silver ratio, again, it was another one of those points that we discussed at the time with gold and silver. It reached its limits where silver would outperform gold. And it happened again. This is the fourth time now in its 30-plus year history. You can go back even further, but these are the two major times that you see it, down and down, falls short, and then it rallies. We've got a reference range, it falls again, and it falls short of the first reference range, and then rallies, and it seems to be what is happening again for the gold-silver ratio, which means gold is going to outperform silver, even if that is to the downside, which means gold would lose less than what silver would lose, which is exactly what is happening right now. Gold down a few percent and silver's basically doubling that. Now, on top of that, you've got copper, which was supposed to be the catch-up trade. If you guys remember back a couple of months, these are all the news headlines. And again, we can see how narratives are destroyed given a few weeks, which is why I don't follow the narratives. The narratives on gold and silver absolutely destroyed. They thought it was all going to continue high to $300 an ounce for silver and 10,000 for gold. Yes, maybe it eventually does, but it's most likely going to need consolidation, as you know, stuff that we've just talked about. The same thing with copper, as they were thinking it was going to be a catch-up trade, has not. It's now broken those levels for reasons unknown, apart from there are more selling pressure than there is buying pressure. It's really should be that simple, but as humans, we love to put stories together in our head that make logical sense. Remember, the markets aren't necessarily logical in the face of what's going on at the time, and it becomes clearer after the fact, which is why charts lead the game. Price leads the game, then the narratives follow behind. The world's largest assets by market value. So I've got this together, put this together here using some data from sources, as you can see here, to illustrate the emphasis on the 18-year land cycle, the economy and land. You can see with real estate, it's one of the biggest assets in the world. It is the biggest asset in the world, 400 trillion. Oil, not even close. Just a bit bigger than a quarter of the real estate value. Then you've got some currencies, the $1, euro, and yen, all up in there. And then gold as well, also a pretty big one, but not even close to the land values, which is why the land cycle is the most important and leads the peak of the cycle. If land peaks, then we're eventually going to all come crashing down. It's going to take time to unfold, but that's the cycle that has been happening for over 200 years using the biggest land market in the world, which is the US. So we can see real estate across the globe, real estate, land, house prices, housing, home price, all of that is basically land. So don't get confused with all the terminology. It's all basically land. More on that later, but if you want to get access to how this works and how it continues to unfold, subscribe to the email list. There is a link in the top of the video description. And we're going to have a mini course come out just on the 18-year cycle if you want to learn more about that, which is why I've got it in the top of the video description. So stay tuned for that. As for Bitcoin and our beloved altcoins, maybe some of you, well, Bitcoin, again, has continued weak. This is essentially still following the bear market cycle. We haven't seen it be able to hold the ground of the $71,000 level on a weekly basis. Only seen it happen once. Last week, not so great. The week that has got 2 more days to close here. If it can hold 71,000, that at least holds the strength for another attempt higher towards that $79,000 to $81,000 level, which is necessary in about 2 weeks' time to overbalance the time and price. So basically to increase the buying pressure, the longer term buying pressure than what we've seen previously. So we've seen some buying pressure, wasn't enough, it collapsed. If this doesn't reach 79 to 81,000 after the 1st of April, I dare say we're going to continue to fall lower and test even further downside between roughly $30,000 to $50,000. Now, on the flip side, 2 weeks' time, we start to see the price close above $79,000 to $81,000. Then there is a much better chance that any declines after that point would be met with either a higher low or slightly lower low, but the declines won't be as bad if it were to fail underneath $79,000. Price fails under 79K, probably going to be much more severe decline than if price is to get over $79,000 to $81,000 after the 1st of April. That is just rating the strength of the decline to come. So that's how we can identify whether we're going to see bigger declines or slightly weaker declines after that point. The other piece of this puzzle is sentiment, and we've only seen one day above extreme fear, and that was on the 17th, and since then it's basically declined. So only able to manage one, barely 2 days. I hit 26. Okay, 2 days above that, and then it's fallen back into extreme fear, but just above those levels at this point at 11. So the next thing to watch is, do we see extreme fear fall underneath the lowest levels here at 5? So with the sentiment fading on the downside, there can still be lower prices. I think most smart traders and investors understand that. But you start to see the sentiment decline and hold higher ground. So if we're in the process of that now, prices can still go lower, but that would just mean they're not going to be as severe as prior declines, which means it's easier to get set in the positions for the next move higher. Next move higher, we'll talk about that in future videos. But so far, everything has continued to follow the plan here. We're seeing the USDT dominance decline and bounce. It hasn't broken 6.5%. So any of these moves that we're seeing at the moment is just all part of the consolidation before further upside for the USDT dominance. That is, Bitcoin against USDT dominance has also had another pullback, so far at a higher low. Remember, this is one of the charts we're watching for lows to form for Bitcoin, and prior cycles have all happened underneath 4,000 on this reading. It's not $4,000. It's just underneath 4,000 on the on the ratio between Bitcoin USD versus USDT dominance, and USDT plus USDC is also holding very, very strong, just combining both of the stable coins together. So I've confirmed the overbalance in time and price for the S&P 500. There's 4 weeks red, also 3 weeks down, not from the top, but still 3 weeks down from this bar here. Last time we've seen 4 red, it's basically gone flat from that point. Now, the other date is the 10th of the 10th October. So really, since this October period, the liquidity has been what I would say is flushing out of the market. Things are getting more uncertain. There is more volatility that has crept into the markets. And I think we're in a longer term process of distribution. I did a post about tops on X. There's a link in the video description for my X account, because not all tops are going to look like some euphoric blow off top, especially depending on which wealth class you're in. You're in the top end, you've got plenty of money because assets have been going up. You maybe invested years and years earlier. And unfortunately, if we're in the bottom end of the wealth pyramid, then it feels like we're all trying to play catch up to those at the top. And it's just not going to happen. We're seeing inflation get out of control. We're seeing interest rates remain where they are, not giving any relief. And in some cases going up, like Australia has done the last couple of interest rate meetings, and things are only getting tougher. This is where we're leading towards the peak, and it's looking more like a grinding peak at this point. Like and subscribe. I'll see you guys back at the next video. Have a fantastic weekend, and I'll see you probably back in Vietnam or Australia. Another video is coming up for sure. Cheers, guys.